crypto is officially the highest performing vehicle over the course of the last 10 years. Shabazz, over the last 5 years, percentage gain for Bitcoin, what was it?
It was around about 970%.
970% over the last 5 years.
So money is all I think of. Money on my mind, 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 money on my mind. So money is all I think of.
All right. Money is on my mind indeed. Yes, everybody. Thank you. You are tuned in to Financial State of Minds, and I am your gracious host, Darrin Harvey. And this is the show where I help you get to that bag, manage that bag, and grow that bag as best as possible as we discuss financial literacy, business literacy, and anything and everything to do with the power of the dollar. And I am today joined again by unofficial co-host of the show. Maurice Shabazz is back in the building today, brother. How you doing today?
Doing good, man. Fresh back from NYC. Had a nice time in the different parts of New York. Manhattan mainly was the place I was based at. But, yeah, man, I'm ready to get back to it, man.
For sure. What were you out there for?
I had to speak at an event. It was Fashion Week. I went to several different fashion shows. I saw some different exhibits, a lot of diversity. I saw Rick Ross's clothing line and all the different male and female. He had some urban wear. He actually had some business wear. I see some business suits on women and some bags. And it was just a good thing to see, man. Just, New York is a totally different vibe from the Bay Area for sure.
Yeah, definitely. Glad you had a good trip and you made it back safely. But yeah, we're going to get right into it. So today's episode, we're back on everybody's favorite topic, investing. They're like, Darrin, you need to make more content about investing. So we're doing that today. And I brought on Shabazz to help me out. So today's episode, where and how to invest now, 2025. So I wanted to talk about this because I need more investing content. Actually, the last time I made an episode about investing was 3 years ago. So things have definitely changed in 3 years. And that was kind of a how-to episode. So if you guys want to check out the episodes called Investing 101, that's the episode where I teach people what everything is, like what real estate is, what the stock market is. Like I really break down the terminology and everything. So if you have no idea on some of the terminology we're going to be using, again, reference episode Investing 101, and that'll put you up to speed. But investing changes all the time. So it's about time that we created an update episode. So first, I want to talk about before you invest, there's some prerequisite requirements that you should complete before you invest. And also, very important that I state this. Yes, me and Shabazz, we're financial experts. I'm a planner. We are in the personal finance space, but we're not wealth managers. And this is not specific investment advice. I got to make that clear. This is not specific investment advice. This is for educational purposes only. So please do your own research on top of listening to this episode. So prerequisites. What should you do before you even consider investing? I have 3 basic rules. Rule number 1, you probably should be making some income. Like obviously, right? Number 2, you need to be debt-free. The exception to this rule are debts that either appreciate in value and or debts that have an interest rate of, I would say, 5% or less. So if you have like a house with that good old we miss it rate of 3%, 2%, 4%, go ahead and invest. That's fine. If you have a car where it's only at a 3%, 4%, 5% markup rate, go ahead. It's fine to invest, in my opinion. That's about it. Or student loans. Federal student loans can sometimes also fall in that criteria of less than 5%. You don't have to hurry up and pay that off. Those are probably the only 3 examples I can think of. So, again, number 1, be making some money. Number 2, you got to be debt free, except for those examples. And number 3, you should have an emergency fund of 3 to 6 months saved up, so you don't have to sell your investments in case you get in an emergency. So those are my 3 prerequisites. Listener, if you do not meet those 3, please get to it. Become debt free as fast as possible. Get that emergency fund built up if you don't already and you are debt free. Do both. Get those in order. Do not advise. This is one thing I will say directly to you. I do not advise anybody to invest unless you meet those 3. Okay, listeners, the ones who are still here, go ahead, Shabazz.
No. I'm just saying it's a good basis. I think everybody should have a set of rules when it comes to investing. I think everybody should have a set of rules when it comes to just about anything, to be honest with you. But definitely investing. One thing I would add to that is get all your finances in front of you, whether you got to write them down on paper or if you use Excel or you're computer savvy, however you need to do it, write it in your notes on your phone. Get all your finances on paper or get all your finances to where you can see them. And that way you could know exactly what's coming in and everything that's going out. I know a lot of people, they know what their biggest bills are, like when it comes to their rent, their mortgage, their car note and stuff like that. From what I understand, when it comes to investing, it's a lot of the little things that we don't calculate in. Those are the ones that you really want to hone in on. Like, what do I really spend all my spare money outside of my bills? What do I spend my spare money on? Right? Am I spending a lot of money on entertainment? Am I spending a lot of money on pampering and getting my hair done, going to the nail shop, haircuts, etc.? Am I spending a lot of money on clothes? Do I have habits? Do I smoke a lot of cigarettes? Do I smoke weed? Do I drink a lot of alcohol? All those different things. Because, like, if you got a weed habit, you probably spend a lot of money on weed, right? So, and I'm just giving examples. Like, you need to know, what are you spending your extra money on? That's the biggest thing, because we generally know what we're spending the biggest bills. We know where that's going. So, and that will give you a clear idea of how much you can invest in, the things that you can cut out. And like, hey, if I stop doing this or if I cut this out, then I could invest that into this vehicle over here, and basically this will give me 5 to 10% return or whatever it is. And I think that's key, man, is just to be able to know exactly where all your money is going. A lot of people don't have a clue as to where all their money is going consciously,
Absolutely. And you kind of perfectly segued and almost kind of beat me to the next step. So listeners who are still here, who meet these prerequisites, you need to know how much money you spend. Normally what I would follow that is you need to know that so you know how much money you can clear out for debt. But in this scenario, you need to know that so you know how much money you can to invest. So the rule that a lot of financial people speak of, and I'm a fan of this, is the 50-30-20 rule. 50% of your income gets spent on needs. So that's your house, your car, your insurances, groceries, etc. 30% of your income then gets spent on wants. So that's where you can buy your Jordans. That's when you can go turn up in the club. That's when you can go to your favorite steakhouse. And then 20% goes, what I would usually say is into savings or clearing out debt. But now that we've met these prerequisites, we can switch those terms from savings/debt to investing. So that is the 50-30-20 rule. And obviously, in order for you to know that, you need to follow exactly what Shabazz was talking about. You need to have everything laid out, whether there's a spreadsheet or you use a budgeting app. I use Rocket Money personally, but any of them will do. That's going to determine how much money on a monthly basis you should be investing. One of the factors. So we're talking about how to look into investing now. Factor one, how much money can you put in? Hopefully at a monthly basis. We want this to be a monthly thing, because if we followed everything blindly the money counselor has been preaching, you now have 20% of your income per month to play with. So number one, how much money can you invest on a monthly basis? Number two, for investing, what is your risk assessment? Are you able to invest aggressively? Are you able to invest moderately? Do we need to be very safe? Maybe you want to do a culmination of that. That's the number 2 thing you need to think about before you even get into investing. And number 3 is, well, what vehicle or what lane of investing are you going to do? And all the research and education that comes to that. So are you going to choose by starting? And let me clarify this. This is for people who are starting to invest. So are you going to start in the stock market? Are you going to start in real estate? Are you going to start in cryptocurrency? Are you going to start in treasuries or buying gold or something like that? What vehicle, and vehicles, by the way, too, can be retirement accounts like 401ks and Roths and stuff like that. What vehicle are you going to do when you're investing? So everyone generally starts with retirement. So you should be maxing that out in doing that if you haven't already. You need to have a retirement account going. But you got that going, you're maxing it out. Let's just make that safe assumption. Shabazz, after that, what investment vehicle would you do in this scenario?
After retirement, I would say insurance.
I didn't even bring that up. Why insurance?
Yeah, I would definitely say insurance. And I would do a like IUL or a whole life insurance policy. That's what I would definitely invest in, and especially if you have children, you definitely want to make them a part of that policy. Whereas I hear a lot of people, hey, I want to send my kids to college when they get of age, right? And I think that getting that insurance policy early on when your children are in their first adolescent stage is probably the perfect time, because it's going to give you about 10 to 15 years to actually invest in that insurance policy. Depending on how much you can invest, when you sit down with a broker, and they'll be able to give you a scenario of how much money your child or your children will actually have access to when they become 18, and how much they'll actually have for a college fund, right? So depending on, I know that when one scenario was, I believe this lady started when her child was 5 or 6 years old. And by the time he was 18, I think she only did like maybe $500-$600 a month. And by the time he got 18, I believe he had enough money to go to an Ivy League college. And so that's the thing. You want to make sure that if you want to invest in your children, insurance way is definitely the route to go. If you are looking to actually become your own bank, that's the other thing. A lot of times in these scenarios, there's a whole nother area where you don't have the scrutiny of actually going through a whole criteria to try to get access to capital, right? When you apply for credit and stuff like that, there's a whole criteria that you have to meet. By investing wisely in insurance, you can become your own bank. You could take money out there. You could take 20, 30, 40, 50 grand or however much that you have in there at the time, and you can invest it in something. And also, it doesn't affect your death benefit. Life insurance is just not for when you die. I know for myself, that's exactly what I thought it was for early on. I wasn't educated enough financially to know that insurance is for while you're living, right? Yeah, I would include insurance after retirement for sure.
I'm so glad you mentioned that. I forgot about insurance as a vehicle. And the crazy thing is that would have been my answer. And that's my answer because that's exactly what I did. So insurance is the vehicle that I picked first. I have a universal index funded insurance policy as well. And shout out to Questy Dreams, who was my very first guest all the way back in episode 3 or 4, which is called Investing Through Insurance. We did a whole episode about that where he breaks that down. But just a quick version is, yes, investing in insurance is definitely the first thing I personally would do. The concept that you described, what is called, there's a term called infinite banking, which is what you just described, which is when you can borrow against the life insurance policy and essentially become your own bank, your own lender to yourself, and you avoid all the prerequisite requirements of needing an income and stuff like that. when you are invested with the life insurance. However, what I've learned also is that infinite banking, you can do that also with any asset. So technically you can do infinite banking with stocks as well and stuff like that. But insurance is by far the easiest way to do the concept of infinite banking. And again, just to shorten it, to make it clear, infinite banking, what Shabazz described, is when you have an asset, for this example, life insurance, and you can leverage or borrow against the asset. And you bypass a lot of prerequisites that the bank or a lender would ask in order for you to borrow money. And you can use that borrowed money to fund other things. And it works very similarly to a 401k loan. It works essentially the exact same way. Right. So, but my understanding is, or at least an example of mine, is that technically the principal is still invested. So you're paying the principal back, but that principal is still invested in the vehicle, so it's still growing over time. So you pay yourself back, and you still get the benefits as if the money or the principal was still invested. Right. I believe that is the concept that I understand. So that's why I went into the life insurance route first, personally. So life insurance is definitely a slept-on vehicle. Great answer. So that's number one. So say someone's doing really well. They got their life insurance policy, whether it's a whole life, universal, they got themselves one. What's the second best vehicle that, Shabazz, you think people should consider before they start investing?
Well, we mentioned retirement. Mm-hmm. We mentioned insurance.
Third best vehicle at that point.
Right. It's all good. From there, I would say stocks, but before even stocks, I would say savings, right? People essentially think, they believe in saving. And some people are actually good at saving, but they're not necessarily saving it in the right place. A lot of people just put money into their regular bank account or savings account, and they just figure that's the best way to do it. Some people do CDs. But I think that probably one of the best avenues, if you're going to actually save, is a high-yield savings account.
Very true.
So, yeah, I would definitely look to institutions that actually give you the highest yield for your dollar, right? And usually they tap out at a little bit over 5% from what I've seen, some of the best ones. But, even if you're getting 3, 4, 5%, that's even good. That's more better than what any traditional bank would give you, such as Bank of America, Wells Fargo, or Chase Bank. I would definitely wouldn't recommend saving in those institutions because, of course, as most of us know, they give you less than 1%, less than 0.5% in most cases, right? So, yeah, I would find some high-yield savings accounts to actually save, and that's going to give you some interest on the money that you're just letting sit.
Got you. So I didn't mention high-yield savings account because, and I should have clarified this, when you have your emergency fund, and the emergency fund should be in the high-yield savings account. And then there's a percentage of that should be in a CD, right? So I should have clarified that. Thank you for bringing that up. It is a vehicle. It is the single safest vehicle other than possibly a whole life insurance. You're guaranteed, regardless of market, going to get the percentage that they're saying. Right now, I can tell you, because I just looked at it, as the recording of this episode, we're in September right now, mid-September. Right now, the highest you can probably get is a 4%. Most online banks are giving anywhere from a 3.5 to a 4. The highest I've seen, and I personally take advantage, is a 4%. And that's with Patelco Credit Union. That's under a certain set of conditions. You have to have a certain amount of money to get that 4%. There's other companies like SoFi Bank and Ali Bank that give a 3.8 the last time I checked, and it's no money minimum required. You can have $1 in there and you'll get 3.8% per year back. CDs, high yield savings accounts, those are investment accounts. You should be housing all of your emergency fund money, all of the money that you're going to invest there. That's where it should be sitting. But all right, Shabazz, we talked about the boring stuff. You know what the people want to hear. They want to hear, what would you do? Stocks, real estate, crypto, gold, which one of those would you do first?
I would say, above all, if you're in position, real estate. I would definitely say real estate. I believe that's one of the most safest and most lucrative investments. Stocks, crypto, up and down. Don't get me wrong. There's ways to actually leverage risks with that. But with real estate, it's a lot more stable, right? So I would definitely say real estate. And that's whether you're purchasing a home or income property, I would definitely say real estate. If you're in a position to actually purchase real estate, that would be great. Of course, there's a lot of details that go into that, but it is definitely a good vehicle to invest in. And basically, it's a long-term investment, of course. I mean, they have short-term real estate investments, of course, as well. And I would say some people may not be in position to actually purchase real estate, right?
Yeah, Shabazz, I ain't got $200,000 to drop on a property. I ain't got $300,000 to drop on a house. You know how it is out here in the Bay Area, man. It's $2 million for a house in San Jose. You're expecting me to get $500,000 for a down payment? Is that realistic for the average listener?
It's not. In some cases, some people don't have the credit. Some people don't have the income. And I get it. They just don't have the credit power or the spending power to actually get into purchasing real estate. So what I would recommend is just to do it on a level that'll work for you. I tell people all the time, go to ground floor. Ground floor, you can start with $100 and they'll even match you $100. They'll give you, so that's $200. You can start investing in real estate, and basically they give on average an 8 to 10% return. They even have some other deals in there that actually give you more of a percentage yield that basically you can invest in if you just want to pick and choose. I want to put some over here or put some over there. They should have different properties that you can say, hey, let me put a percentage over here. Let me put a percentage over here. And you can spread it around.
Before you continue, ground floor, I know what that is, but can you clarify for the brand new listeners, what is ground floor?
Ground floor is a platform for entry level people that actually start investing in real estate. People who do not have, so it's a website, it's also a mobile app. And for people who actually don't have thousands of dollars, you don't need a lot of money to invest, right? I mean, of course, if you have a lot of money, invest, great. But for the average person, they may not, in most cases, and especially in this society, they may not have a boatload of money to actually invest. So if you want to get in, they'll let you start with as low as $10. But I would say do $100 so you can get that $100 credit as well. Anything that anybody's going to give you to help you invest, you definitely want that. You're investing in real estate. We need to start understanding the concept of, and now you're just the idea to know that, hey, I have some money in real estate. It may not be a boatload of money, but I have some money in insurance. I have some money in retirement, and I have some money in real estate, and I have some money that's actually getting me interest in a high yield savings account. Just knowing that your money is working for you.
Absolutely. And to further clarify, I believe you're talking about the concept of REITs in general. Right. So for listeners, there's a term called REITs, and it's essentially when people ask this question, Darrin, I got $1,000. I want to invest in real estate. Well, obviously, I can't say go buy a house, right? It doesn't matter where you are in the country. You can't buy a house $1,000, but you can throw $1,000 into REITs. And Shabazz is essentially explain that entire concept. For an example, I just learned about, listeners, you can invest into a REIT where the owners of that REIT own the Vegas Strip.
Right.
And what they showed was that the Vegas Strip in the area around there has some of the highest rates of tenant occupancy and paying. They actually looked it up. It was 100%. Even during the pandemic, 100%. The tenants over there on the Strip were paying, which makes sense. So again, when we ask the question, and this is kind of what I want us to focus on too as we continue the conversation, the average listener right now does not have $500,000 to drop on to any investment vehicle. They probably don't even have $50,000. Everything I want to try to gear to this episode listener is for the average listener who can maybe do a couple $100 a month, or maybe they have a windfall of $10K or less. You can start right here. And then if you have more than that, if you have 50, you got a windfall of $100,000 or $250. this is still, the money doesn't change it. What we're talking about and what we're describing, this is beginner level, and this is what you should do as a beginner, regardless of the amount of money you decide to start and drop in with. REITs and ground floor, like Shabazz was talking about, is an excellent way to get started into real estate. Real estate usually would have been my answer, and I've said that answer many, many times on this show historically. But that's no longer my first place I would go after insurance, after having the CD yield or high yield savings accounts. I would start in index funds. Now, you can get a REIT that is basically an index fund for real estate. So I would probably do that if I'm starting now in 2025. Get that REIT, specifically the ones of where you can see that the turnover rate and payment rates for the landlords are like in the 90 to 100% percentile. And then the average right now is 8%, 7 to 8%. There are some giving like 14%. So, which is basically beats the S&P 500 average. S&P 500 is doing great right now, which is my number 2 listener. That is my number 2. And that is the one where I have a 5-figure amount of money invested right now. The S&P 500. That would be traditionally the number one thing I tell people to start investing in. If I had $1,000, $10,000, or a couple $100 a month to throw per month, S&P 500. Why would you not want to have a piece of Amazon, a piece of Tesla, a piece of Nvidia, a piece of Apple, a piece of Facebook or Meta? All of these companies that are not going to ever go out of business in our lifetimes. You may even get a piece of like Starbucks, Bank of America, McDonald's. These are 100-plus-year-old companies that are not going to go out of business. I would start there. The reason I start with those options, everything we said up to this point, I would start there because the risk level is very low. Low to moderate, depending on the REIT you decide to pick or the index fund you decide to go with. But pretty much everything we talked about is either low risk assessment or I almost want to say dang near non-existent risk assessment.
Right.
Your life insurance companies, as long as you pick the right company, they're going to pay you out. I literally talked to my broker and he's like, Darrin, I know people who got the policy, passed away within that year, they got paid out that full amount, even though they were only in it for a year. So, and the life insurance companies are 100-year-old companies, generally speaking, if you pick the right one. Very, very safe. So I want to summarize by saying, in my opinion, you should start with safe investments first if you're a beginner. And this is also true if you have kids, dependents, your risk assessment is probably going to be very low because people depend on you. So you want to start with the low but safe investment vehicles. Low meaning not the highest average return on investment. That's going to go to your moderates, which moderates I would say are like individual stocks or maybe index funds that are naturally moderate or REITs that are naturally a bit more moderate, a little bit more risk, meaning that you're going to have an opportunity to make a higher average return on investment, but there is a little bit more risk and it may take a little bit longer for that to happen. One thing I also want to clarify too is I am a fan of long-term investing. Shabazz has been talking about avenues that are long-term investing. I typically do not do short-term investing in general or invest in things for short-term gains. For tax reasons and for other reasons, I choose not to do that. Nothing against people who do, but for the purposes of this episode, we're really having emphasis on long-term investing. Long-term being 10, 20, 30 plus years down the road is when you're even going to think about selling these investments for a profit. I would say stock market is the overall best way that I would do it if I were to start again in 2025. With index funds and then maybe a more moderate, aggressive index fund that may pay out more dividends or something like that. But that's where I would start. But there are other vehicles that people want to know more about. And I'm going to leave it to Shabazz. What are these other vehicles that people want to know about? There's a big one.
Crypto, of course.
Crypto. So people want to know about crypto because crypto is officially the highest performing vehicle over the course of the last 10 years. Shabazz, you said it before we started. Would you like to tell the guests over the last 5 years percentage gain for Bitcoin? What was it?
It was approximately 970% over the last 5 years.
970% over the last 5 years. I want to make this clear. Nothing else we talk about will beat that. But
yeah,
we were talking about low risk assessment,
right?
Medium, moderate.
Right.
I should have probably said one that was high. No, we went to the literal highest option you can possibly do. The literal highest is cryptocurrency. That is, bar be it maybe NFTs, the riskiest way to invest your money. So yes, if you invested 5 years ago, you would have got essentially 1,000% return on investment. Just for you to understand what that means.
Right. Exactly.
If we invested $100 into crypto 5 years ago, where would that $100 be right now?
You would have made about $1,000 on that $100.
Yeah. So you would be $1,100 doing nothing. So
yeah,
I know people listening right now are like, we're going to go buy Bitcoin right now. That's just the best option for me, especially if you're 20 something, you're in college, you're just like, I want to get that money right now. Hold up. Episode's not close to done. We're going to tell you why that might be the last vehicle you may want to go with. And before I get to that explanation, I want to remind you guys, you're listening to Financial State of Minds with your boys, Blindy McFly, Darrin Harvey, and Shabazz, right here at 96.9 FM. And we're breaking down how and where to invest in 2025. So, had to do that now. Before people go run and get that crypto, yes, overall, it's done 1,000% basically in the last 5 years. But listener, while you're doing your research, because that's what I told you to do, you will see how badly that thing has dipped. There has definitely been points that, yes, over, I think like the last year, it's gone up 100% just over the last year. But I've looked at those charts, man. On camera, I'm going to show you guys, but I'm going to verbalize it too. It is goes up and then way down, and then up, and then way down, and then way up. And it's just constant way up. So if you're going to do crypto, I do believe that you should allocate a small percentage of your portfolio into crypto and hold it. Hold it for years, because at any point, literally, we can wake up tomorrow and that 1,000% over 5 years is probably going to drop down to 900. Because it's just so volatile.
Yeah.
And my personal opinion, Shabazz is more the crypto expert than me, so I want your opinion. If I am going to invest in cryptocurrency, it's going to be Bitcoin. That's the only one I would be interested in. But Shabazz, I know you know more about crypto. If somebody's buying crypto for the first time, again, $1,000 they got, maybe $5,000, maybe they can only do $200 a month. Where can they go to get it? Where they can go to get some Bitcoin?
A lot of people, just about everybody has Cash App. So that's probably the easiest way to access it. If you're using something like Cash App, I'm not sure if Venmo has it yet. I don't really use Venmo, but if they do, that might be another avenue. They have a section on Cash App where you can invest. And basically, if your debit card or your bank account is attached to your Cash App, you can invest in Bitcoin right there. Bitcoin is not hard to get to in most cases. If you want something a little bit more professional, you probably want to use something like Coinbase to purchase crypto, or you can use something like Uphold. Some people come to me and say, well, I have Robinhood. Well, no, they're not really conducive to crypto investing. They're more stocks. So I guess a lot of stock accounts, some you could invest in both. Some brokerage accounts you can actually invest in stocks and crypto. But most of them, from what I've seen, you can only invest in stock on certain platforms. I would say Coinbase. I think they even give you, when you sign up, I have a link where you get about $30 in Bitcoin if you sign up. But I think they at least give you $5, if I'm not mistaken, just by starting. And if you want something better than Coinbase, I would recommend Uphold. So, yeah, those are the things. But if you just, I don't have time to apply for something new or something that I don't know of, so if you're using things like Cash App, you can easily invest in it right there.
So wanted to get the crypto out there because I know people just want to know more about crypto. So that's our take on crypto. I would use Coinbase personally if I were to start getting into crypto. You can also, there are also crypto ETFs. So like you're not going to be able to buy a whole Bitcoin with just $1,000 at this point.
Absolutely not.
No, I think the last time I checked Shabazz, it was like one coin was like 150,000, something crazy like that.
Yeah.
So you would essentially be buying pieces of that coin. You can also go to a place like Fidelity and they have coin ETF and stuff like that. Just to clarify, when you do this, you're most likely not going to own a full Bitcoin. You would own pieces of it. But still, again, like we said earlier, you throw $100 into Bitcoin, over 5 years, the last 5 years, it would have been $1,100. So definitely, if you're doing really good, if you want to be a little bit aggressive, or you just want to be totally aggressive, and the most important is you won't miss that money if it all goes away. Mm-hmm. Crypto is the best option right now as far as the benefit of it, but you are putting yourself at high risk. So we talked about insurance policies. We talked about high yield savings accounts. We talked about the stock market. We've talked about real estate. What other avenues of investing in 2025, Shabazz, can people do?
Before I get into that, let me chime in on crypto just a little bit. Because Bitcoin, when people think of cryptocurrency, they think about Bitcoin is the main thing.
Right.
When cryptocurrency was first invented and we first heard about it, there were three main coins that basically were out. So don't sleep on Ethereum and Litecoin. Bitcoin, Ethereum, and Litecoin were the first three digital coins that were actually created at that time. And, Ethereum and Litecoin, they're cheaper than Bitcoin. Bitcoin is the 500-pound gorilla in the crypto space, of course. Right. But don't sleep on those. One of my other picks that I would say is invest in crypto coin, digital tokens that actually have something to do with AI. So I would definitely.
That's a sleeper right there.
So I would definitely invest in those. I believe Algorand is one of them, but they have several of them. Digital coins are associated with artificial intelligence. So that's just one thing I would say. Now, as far as another investment that I always look at, I say this all the time, is two areas, really. Invest in your credit. And the reason why I say invest in your credit, because it is extremely important and essential, especially when it comes to investing. And I think that when I talk about credit, people often, their mindset about credit is totally different than what it should be. And the main thing is I want to help people understand what is credit used for, what is the tool of credit. And I always explain this to people. Credit should be used to make more money. It shouldn't be used for anything other than that. Think about it for a minute. You need credit to invest in real estate. You need credit for a lot of things, essentially, but we talked about real estate being one of the investments. You need credit for that. That is actually going to help you make more money. That's actually going to make your money work for you. And if you use credit in that way, not to finance things that you can't afford, but if you use credit just for the purpose of making your money work for you, just think about it. You're actually using somebody else's money to actually make you more money. I mean, how simple of a concept is that, right? So I always tell people, invest in credit. It's going to be one of your biggest assets if you use it correctly.
Right. And people, if they've been following along in this podcast, they know their credit score should be good, right? If you cleared out your debt, your credit should be in the 700s at that point. So if you follow the prerequisites, you already have good credit. And yes, in certain instances, it does make sense to leverage your credit and borrow money in order for you to invest and make more money. That is especially true in one vehicle that I would say that's the most appropriate for, and that is a business. So building a business, that is a form of investing. Investing, whether it's into your own business. So whether investing into your own business to build it up, you can leverage your credit for that. Or at the end of the day, investing into the stock market usually is investing into businesses too. So definitely want to do that. But listeners don't want to hear that. They're bored. Shabazz, I've been hearing about gold. Gold, is that a good one to go to? Gold right now, I've been hearing. How do you feel about gold as an investing vehicle?
Gold is a safe haven. When you see inflation and you see the price of things constantly going up and you see the fluctuation with stocks and everything, gold has always been a safe haven for people to invest in. Gold has only went up in value over time. What gold was worth 10, 20 years ago, it's worth way more today. One of the reasons is that paper currency fluctuates. Gold is more tangible. It's a controlled vehicle. Whereas, like I said, gold it holds its value.
Right.
And it only has increased in value. The dollar has not increased in value. That's what we have to be clear on.
It deflates.
Right.
It goes down in value over time because they're printing more of it, listeners. So it's historically going to go, it fluctuates. I won't say it goes down, but the dollar fluctuates over time. Gold is the oldest form of currency, actually. It's actually the oldest form of currency. And gold is a great place to put your money in because when things are bad, during the recession, that's when gold is at the best. If all these listeners who are worried about recession, you feel you're in a recession right now, put your money in gold. If you're afraid of a recession, if you're afraid about inflation and the dollar going down, gold historically number one place to put money. If you're that listener, put your money in gold. Last 5 years, gold has done, I believe, 70% positive return on investment. So gold's doing great right now. But gold, another good vehicle. Ones that people sleep on too, that doesn't get to talk a lot, but is very safe, is treasury and bonds. Shabazz, you want to explain what treasury and bonds are to the listeners?
So they have a lot of different treasury and also bonds. I'll talk about bonds. Most of the things that you see that people invest in are associated with some type of bond. You got tax bonds, you got real estate bonds. It's several vehicles where bonds these investment vehicles are basically bonded. By investing in them, it's still the concept of buying and holding, right? But they're low to really low risk in majority of the cases if you're going to invest in bonds or if you're going to invest in treasuries, right? And the good thing about treasuries is that if you get an account with Treasury Direct, you actually can invest in treasuries without having to deal with a broker, without having to go through anybody. You can actually purchase them. That's why I call it Treasury Direct. You can purchase these treasuries directly. And I think that when it comes to investing, you want to have more control over the things that you invest in. And if it's a scenario where you can cut out a broker, of course, you definitely want to, because then that's a percentage that you actually that goes away to a broker, right? Mm-hmm. So, yeah, I would urge everybody to get an account with Treasury Direct and do your due diligence on these treasuries. If you're going to invest, see what the percentage yield is over time, because these are more longer-term investments. Mm-hmm. And like Darrin said, everything that we're mentioning, they're low to moderate. The short-term investing, that's more high risk, the short-term investing. Not saying there's nothing wrong with it, but that's for, I would say, a more experienced investor, right? Because it's extremely high risk to be in and out like that. Buying and holding, if you look at any stock, you look at any bond, you look at any treasury, and even if you look at real estate, if you look at the charts over the last 10 to 20 years, of course, it's volatile, it has dipped. But if you look, it always goes up over time, right?
Right. And unfortunately, we're going to have to make a part two because we're already out of time. So listeners, I'm sure we might have to just do a follow-up immediately after this because there's so much more we can talk about. But we are pretty much out of time. We got like 2 minutes left. So Shabazz, as always, I want to leave room for you. Where can people find you?
Hey, find me on Instagram. That probably is the easiest way. Maurice_Shabazz. You can find me on Instagram. I got a lot of information I have on there and the resources I share.
All right. So that's where you guys can find Shabazz. I know we had to cut this episode short, and we're gonna make a part 2. We got to make a part 2 just to keep this going. There's more we can talk about. But yeah, that's it. We got to get out of here, you guys. This has been your gracious host, joined by the unofficial co-host, Darrin Harvey, Financial State of Minds. This is the show where I help you get to that bag, manage that bag, and grow that bag as best as possible as we teach financial literacy, business literacy, and all things related to the power of the dollar. Peace, and queens. Don't forget to check us out at www.financialstateofminds.com. Don't forget to check out this episode on KGPC96.9.org and all streaming platforms. It's going to be available there as well. Thank you guys for tuning in. Peace and queens. We are out of here.